Trustee Kwan,
Here.
Trustee Santos, Trustee Woosley,
Here.
Trustee Flicker,
Here.
and myself, Trustee Gardner's here. We also have one, Trustee Menon, are you online?
I'm here, yeah.
All right. We do have some people absent. Trustee Votto, Trustee Ganapati, and Trustee Lee are going to be absent today. Trustee Menon, we do have a couple questions for you, and I'll go ahead and turn that over to council.
Yes, Trustee Menon, you are appearing by the traditional Brown Act teleconferencing rules. Are you teleconferencing from the address 1162 Briarwood Way, Walnut Creek, California, 94597?
That is correct.
Is the location from which you are teleconferencing ADA accessible and open to the public?
Yes,
Have you posted the agenda on the exterior of the location where you are teleconferencing from so it can be seen by members of the public?
yes,
If any member of the public wishes to be heard by the board from the location from which you are teleconferencing, can they be heard?
yes,
Trustee Menon, you are qualified under the traditional Brown Act teleconferencing rules to participate in today's meeting. All votes today will be taken by roll call vote.
thank you.
All right, thank you. Just to repeat, as council mentioned, today all votes will be roll call vote. There are no orders of the day or sunshine that needs to be waived. So at this time, we are going to proceed to closed session. out from closed session. So we'll go ahead and move to public comments. Is there anybody from the public that would like to make any comments that is retirement board related but is not on the agenda? If so, just raise your hand. Looks like there is none. So go to the consent calendar. Is there anything on the consent calendar that people want to pull?
Motion to approve.
Okay, we've got a motion by Santos to approve,
Second.
second by Flicker. Any other comments? If not, do a roll call vote. Kwan,
Yes.
Flicker,
Yes.
Gardner's a yes. Santos,
Yes.
Woosley,
Yes.
and Eshwar.
Aye.
All right. All right, that brings us to investments. Oral update by the CIO. Looks like Jay might be joining us.
Good morning.
Good morning, Jay.
Yes, good morning. Thank you for the opportunity to fill in for Prabhu, who's traveling. Save your hard questions for him. He's coming back later today. So we have a pretty full investment agenda with staff and our consultants ready to present our normal set of quarterly performance reports. I did want to provide a few quick updates before we get started. So first, our standard estimate of plan returns, and the standard caveat here is these are always estimates based on a combination of actual plan returns and then index proxies layered on kind of the latest time stub. These are helpfully provided by Makita, so through June 3rd. Happy to report that fiscal year to date, the pension is estimated to be returning 7.8%. And the healthcare trust is 8.1%. Again, those are fiscal year to date estimated returns. Healthy margin above the 6 5/8. So just say the word, we'll sell it all, lock it in, and wait out a couple weeks. Just a joke. Second, we're approaching our June 30th fiscal year end. We have some fairly standard quarter end rebalancing going on right now, and you will see our fiscal year end actual positions relative to our policy target weights in the next round of performance reports. That probably comes in September. And you'll see those reported out from March a little bit later this morning. So again, those are just on a standard quarter lag. But on the first day of the next fiscal year, which is July 1st, we also have two things occurring. So the board chose to just tweak the strategic asset allocation slightly earlier in the spring. If you'll remember, there was basically just a reweighting within public equities. At the same time, the city as plan sponsor opted to pre-fund their Tier 1 employer contribution, which is just under $200 million for the pension. So we'll be using the capital inflow provided by the pre-funding in part to complete the strategic asset allocation tweak and get the plan to the new targets that you chose. So both of those things will be occurring at the same time at the start of the next fiscal year. Other portions of the pre-funding contribution will go towards things like topping up the 5th year of the immunized net cash flow account, which, as a reminder, sets aside the projected benefit payments net of sponsor contributions for the next 5 years. So again, on the first day of the next fiscal year, the plan will be at your new strategic asset allocation targets, and we'll also have topped up that liquidity buffer to a full 5 years. So just to finish the update, in addition to the rebalancing and other associated activities, we're also on our way to preparing the annual fee report. This is the comprehensive report that aggregates fees and costs across all of the strategies in the portfolio. As you might remember, it's quite a data collection undertaking, and this year a combination of Harrison and Ron are going to be tag teaming on the report and getting it ready for presentation in the fall. So if you get a chance, wish them luck. Just check in on it. The rest of the team is chugging along, as you'll see as we make our way through the performance reports. I'll take any questions now if you have them. Otherwise, we're going to get started with Dinesh and Casey.
No questions? All right, let's go ahead and go to Newburgh Berman, which is 2B.
Just the one comment, 7.8.
I know, great returns.
Thank you. And we have Casey Boyer from Newburgh Berman on the line to present.
Perfect, thank you, Dinesh. I will share my screen in a moment. Okay, hopefully that's visible to everybody. Thanks for having me. I'm here to go through Q4 for San Jose Police and Fire. We do have some good news, and I'll kind of go through highlights of the portfolio and kind of what we're seeing in coordination with that over the overall private equity market. I'm turning to page 2 here, which is kind of the high-level overview, but does a good job of highlighting some of the statistics for Q4 and kind of since inception with the investments. If you'll remember, we have 2 series of investments. So you'll see those 2 middle columns represent the Newburgh strategic plan with your team. Both same investments, same investment strategy, just simply breaking it up into what we call series or tranches. So for Series 1, that is the initial tranche when we started investing back in 2017 on your behalf. So that series now is fully committed and slowly, nearly fully, and getting to a place where all the capital invested is slowing down. And what we're now starting to see is a maturing of the portfolio, leading to distributions or realizations within your portfolio. So if you look at Series C, one of the bigger changes over Q4 is this distribution number. We've now returned back a little over 75 million. In Q3, that number was 62 million. So we were able to get back to you close to 13 million just in Q4. And how that relates to overall 2024, prior quarters, it was closer to just 2 million. So Q4 was a pretty good year in terms of, a pretty good quarter in terms of realizations. We do tend to see that in Q4 where more transactions are trying to close by the end of the year. So that played out nicely here. I will say, and kind of caveat that statement with the overall private equity market is still very, the distributions that are happening currently in the private equity market are still much lower than historical averages. So when we think about 2025 and kind of what has happened so far, I would say distributions have been more muted. However, we have distributed about 5 million so far this year back to the plan. But that's really what has been happening over the entire market. As you know, there's been volatility politically across the world, and so a lot of that has played into some of the slower distribution market. If you would have asked us in 2024 what was going to happen, we would have told you we feel like distributions are going to pick up. So that has kind of been brought back a little bit. In terms of Series 2, this is the newer series. We are now nearly done with the 2-year period and looking to commit into next year, which would be year 3, and working with your team closely on a plan for that and what that looks like in terms of new funds coming to market and what investments we would put to work. For that fund, we're still actively committing, actively investing capital, and is much too early to see distributions at this point. If we go to, I'm going to go flip through some of these very detailed pages and take you to some comparisons here of the overall portfolio. So again, page 12, Series 1, you can see what the net returns are for Q4 and what they were in Q3 and how that relates to benchmarking across the board. So you'll see Q4 was written up a little bit in Series 1. Again, that was kind of the overall broader market. We saw slight write-ups, but kind of closer to par in the unrealized valuations within your portfolio. So not a terribly big movement, but definitely upward movement. So that's a positive thing. And then when you look at Series 2, again, this series is still very much committing, dollars being put into the ground. So as soon as an investment is made, that investment is held at cost. And so sometimes when you're starting these new series or new investments, your returns can stay pretty even for a period of time as you're putting new capital in at cost. So it was nice to see a little uptick here in Q4 where we went from 1.1 times multiple in Q3 to 1.18 in Q4. From a benchmark standpoint, still very early, and we typically don't benchmark. The benchmarks aren't even available for a period of time. Given investments are just so new, there's not really much to compare at this point. You'll see, an early driver of returns in your portfolio being secondaries. That's really why we put secondaries into this portfolio, to give it that early boost. I will be the first to say this number will come down over time, just as we put more secondaries in and kind of they all even out a little bit, but it obviously is a smaller part of your portfolio. But it is very positive this early in the portfolio to see primaries at a 1.12 times. Sometimes those take a little bit longer to develop, so some positive movements there already. I'm going to look at my notes and see if there is anything else that I wanted to highlight. I think just if you're thinking about the year 2024, it was a year again of muted returns and distributions across the private equity landscape. Your portfolios, if you're looking from the end of 2023 to the end of 2024, overall performance was up slightly. For Series 1, the 2023 mark was 1.74, and as a reminder, for the end of this year, it was 1.83. So we did see some upward movement, which was great. Some additional distributions in Q4, and just a little bit unknown still for 2025. I'm going to pause there and open it up for questions and allow Dinesh to add anything that I missed.
Nothing further. Happy to take any questions.
Yeah, Andrew, can I ask you a question?
Go ahead, Ishwar.
Either of this could be the Casey or Dinesh, but we've all seen the headlines about college endowments selling, I guess, some of their holdings, private equity holdings. Do you think that as we go through the rest of this year, that maybe that'll impact to the extent that those pricings come down, those markings come down? What sort of impact do you see on our own portfolio?
So I don't think that part of the market will, the sale of assets or portfolios of other endowments or LPs, I don't think that will affect your performance. It could allow for some interesting secondary opportunities on LP side that we are actively looking at. You know, the LP side, you have to think about it in terms of not only what's coming to market, but what is the discount, because typically there is a discount, and so you're trying to figure out if the discount is appropriate for the investments that you are acquiring. You know, that's kind of just deal by deal and really looking into the assets and making sure that we understand what the upside potential still is. And so I think, yeah, it's more from a what investments could we put into your portfolio rather than what is there right now.
Yeah, so the secondaries, I agree, that could be an opportunity. But to the extent that, let's say Yale is selling, they're holding in a fund, and we are in the same fund, and if that's sold at a discount, wouldn't we have to mark our fund holdings down too?
No, that's primarily a secondary process. Doesn't affect how we would actually be invested in that fund. So that fund still is holding investments, and outside of that secondary process, they have very real opportunities to sell investments out of their portfolio. Typically, what we find is that GPs sell companies for higher than they have been holding them over the prior 2 quarters. So I would argue the opposite. Those LPs that are exiting in the secondary market, they are taking a discount knowing it's a discount to them.
Okay, thank you.
David, do you have a question, comment?
Thanks, Casey, for the presentation so far. Maybe this first question may be a little bit rhetorical, but I'm going to ask it anyway. Your comment about distribution being muted, what's your outlook on distribution in 2025? Is that also going to be muted as well, or do you think that that may change just because, I guess, there's expectation of interest rates coming down? I'm hoping that that's going to change it, but I don't know. I guess maybe I'd like to hear your comment on that, number one. Second question is, given that we're still in the state of a muted distribution from these investments, will that impact your investments going forward? Primarily, I think you might have mentioned this, primary investment versus secondary investments. Would you skew one way or the other? I guess I kind of want to get a sense of that. I mean, the question could be for any one of you too.
I'll let Casey take the first crack.
Yeah, I'll start. So for 2025 distribution expectations, like I said, we started 2025 thinking, okay, this year it's going to build momentum. Everything was kind of trending in that direction. GPs were in a lot of different processes to sell. We saw some positive movements in the IPO market. The interest rates, of course, have affected that in the past, but we kind of felt like at some point there's a deciding line where GPs are just going to have to start selling regardless of interest rates. And of course, we saw some movements there that were positive that we thought could lead to more distributions in 2025. What really put everything on pause a little bit was Liberation Day, to be honest, in March. I think that just put a pause on process for new sales. So GPs didn't drop their process. They just said, okay, let's wait a little bit and see how these tariffs work out. Now there does seem to be some comfort level around at least what the expectation is, and so there does seem to be some movement. But I think what we have seen so far is the first half of Q1 muted distributions. Our hope for the first half of 2025, our hope for the second half of 25 is that we see an uptick and we kind of see more what we were expecting for 2025. I think in total, 25 will be less than what we were hoping, but hopefully at least in line with what happened in 2024. That was your first question. Your second question, I'm sorry, I didn't write that one down. What was your second question?
It's related.
How we would move between primaries or secondaries?
Yeah, how we would invest in this space going forward, given the muted distribution.
The good news is that we have a lot of flexibility, and we are in constant communication with your team, Dinesh, on all of those opportunities. So, and we also, as you know, annually figure out an investment pace and how much we should be investing each year. And so we've actually already done that for the next year. And each one of those primaries, secondaries, co-investments has its own cash flow scenario and NAV curve of what opportunities we need in order to hit your NAV target. And so a lot of that we're looking at just from a top-down basis, and then a bottom-up, we're looking at what the opportunities actually are within. And I would say we have a lot of flexibility to move between those based on what the opportunities are at hand. Secondaries and co-investments are really opportunistic, and there's different time periods over the last 15, 20 years where you would do more secondaries than normal based on the market, or you would do more co-investments than normal based on the market. In the last 10 years, we've done more co-investments. That's been a more attractive market, but it's always open to take advantage of what the market is sending us. So I would answer that with there's a lot of flexibility, and we would move to whatever makes sense.
And if I can add to summarize both of those questions. So first, on distributions overall, I think there's been a lot of pressure that LPs are putting on GPs, so they're aware that it's something that's important to us as institutional investors to get our money back as the fund lives and the stated investment periods are coming to their ends. And I think GPs get that. They're working on providing liquidity in different ways. That's why they've created new innovations like continuation vehicles and other forms of generating liquidity. And I think also it's really uncertainty that's holding back the distribution. So GPs, when they're looking to make new investments, they want to make sure their most likely outcome is a return greater than 20% per year. So if they're not able to do that as their base case, they're going to wait to make a new investment, and existing investments will have to stay longer for that case. And then on the second point of what type of opportunities that exist, so for us on the pacing plan itself, the current fiscal year, which is coming to a close this month, we were committing $150 million per year for private equity. The upcoming fiscal year, it goes down to $125 million. So there is some reduction because of that slowdown in distributions. We were about, if I remember correctly, about 90 million behind distributions of where we had projected we would be. So pretty big change. That's why that investment pace has reduced, but we're still continuing to make investments. And then the actual investments that we do make, just like Casey mentioned, we have flexibility. We're not stuck in some boxes of how much primary, how much secondary co-investments. It's just really lumpy and based on the opportunity set. More recently, I think the co-investments and secondaries have presented greater opportunities than the primaries, which, especially in a slow deployment environment, there's a lot more uncertainty going into a blind pool. You don't know how that money will end up getting deployed versus a co-investment or secondary where you have more line of sight on what is the investment, what is the structure you're getting. Because of the illiquidity and less capital that's in the market, we're able to command better terms, better return expectations for the level of risk that we take as a result.
Thank you for your thorough answers.
Thank you.
Any other questions for Casey? If not, thank you, Casey, for the update. We'll go ahead and go to 2C, looking at fourth quarter for private markets by Makita. And as they walk up, you guys could definitely go straight through to the first quarter report and also healthcare trust.
Great, will do. Good morning, members of the board. Laura Wyrick from Makita Investment Group, joined by Colin Kowalski. Colin's going to start us off today with a discussion of the private markets program as a whole, and then I will discuss the pension and healthcare total fund reports.
Great, thanks Laura, and good morning everyone. Give me one moment to pull up the materials and we'll get started. All right, here is our performance report for the private markets through the end of December 2024. So this is through the end of the year. And Casey just touched on the private equity component, so I'm going to go ahead and preview private debt, real estate, real assets, and venture capital, which are listed in the table here. They're listed in order of inception year. At the end of the year, the total combined committed capital was about $2.6 billion. There was a number of new commitments made in the fourth quarter, and I'll highlight those as we go through the report. But that number has jumped up about $150 million since the last version of this report. And so there's some new investments, which we'll touch on in a moment. Remaining value for the total plan here was $1.25 billion at the end of the year. And the combined IRR for this entire program was 9.6%. So a very strong IRR on an aggregate basis. One other piece I'll point out on this page is the IRR of each component and that column on the right there compared to the PME IRR. And so the PME is the public market equivalent benchmark, and that takes the cash flow profile of each component here and models that being invested in their appropriate public market. So that's a public market equivalent. If you go up and down the board here, almost every single component here has outpaced its public market equivalent, with exception of venture capital at the bottom, but some strong absolute returns across components here, and also relative returns compared to their public markets. I'll jump a page ahead and talk about private debt. So at the end of the year, private debt allocation was at 4.2%, and that's slightly below its 5% target. In total, the IRR for private debt since 2010 is 6.9%, so a healthy return there. The next page shows those new commitments that I've talked about. So in total for the fourth quarter, about $84 million in commitments across the three funds listed on this page. That would be Silver Point, Arbor Lane, and Strategic Special. So some new commitments were made, and those are now on the report. Jumping to performance, I'll move to page 5 and 6. These pages show the individual partnerships within private debt, and they compare returns and also other performance ratios such as the distributed over paid in and total value over paid in. Those are the DPI and TVPI columns there. New columns that we've added actually to this exhibit are the peer DPI and peer TVPI. So that takes the peer group ratios for those and compares it to each individual partnership as well. So that's a new performance metric that you can look at. Up and down the board, there's some really attractive returns on an individual basis if you compare those IRR and other metrics to the peer group. Notably, between years 2018 and 2022, there's some really strong individual performers. In aggregate, as I mentioned, this returned 6.9% on an IRR basis. The next page shows exposure across vintage years and geographies here. Vintage year diversification is a huge component of building a private markets program. The private debt program is very diversified across vintage years, as you can see from these pie charts. So that's something we monitor, and it's looking very healthy if you look at this page. From a geographic standpoint, this program remains primarily invested in Northern Europe with a sprinkling of Western Europe and other global diversified geographies. Moving ahead, we can talk about the Real Assets program here on page 8. So this is one of the newer programs. The chart here starts in 2015, and as you can see, this program has been building up towards that 4% policy over time. At the end of the year, was at 3%. The IRR for this program is 10.9% since inception, so some really strong, healthy returns on an aggregate basis. The next page here shows some of those new commitments in the fourth quarter, Pelican Energy and Lime Rock. In total, about $30 million in new commitments across the Real Assets program. And then from a performance standpoint, pages 11 and 12 again show the individual partnerships compared. It shows those performance metrics compared to peers. As I mentioned, this is a bit of a newer program compared to the private debt one, so there's a handful here that are listed as NM, not meaningful. So still a good amount of commitments that are early in their life cycle. But if you do look at the ones that do have returns, there's a lot that look really strong compared to peers across metrics. And as I mentioned, in aggregate, this program has returned 10.9%, a really healthy return on an IRR basis in aggregate. From a vintage year and geographic perspective, these remain pretty diversified as well. You can see the vintage year, again, is spread out across many recent years there, so that's something we monitor and it is good to see. From a geographic standpoint, this one has more exposure to the rest of the world outside the U.S., so you can see global, developed, and emerging, and Asia allocations there on these tables. Moving to real estate, this is a program that's slightly overweight, actually. It's 4.4% at the end of the year relative to its 4% policy target. And the IRR for this program is 9.5%, so again, another healthy IRR out of the real estate program. There was a new commitment made this quarter for the first time in 2 years. There was a bit of a pause, but this in the fourth quarter, a new commitment was made to Blue Owl Digital 3. That's a digital infrastructure fund that invests in data centers. So it's a really exciting space right now that I think we're excited about. And so that commitment was made in the fourth quarter, and it's listed on this page. From a performance perspective, pages 17 and 18 again show the individual private markets partnerships. This one's a little bit more of a mixed bag, but if you compare individual partnerships to its peer IRRs, more than half of them have outperformed their peer IRRs, so some good relative performance from individual underlying partnerships, and again, a strong aggregate IRR of 9.5%, which is strongly outpacing its public market equivalent, not shown on this page, but that was shown on that first page I talked about. Again, from a vintage year and geographic standpoint, this is very diversified across vintage years, primarily focused in North America, but a sprinkling within Western Europe and other global developed markets as well. And then finally, the last program that I'll go through is the venture capital. Again, so this is the newest program. The chart here starts in 2019. At the end of the year, it had a 2.3% allocation. And that's actually a pretty significant jump from the third quarter. It was at 1.8. So there was some good capital deployed within the space in the fourth quarter. That's showing through in its overall allocation. Still well below the 4.5% target, but again, this is a new program and it continues to build over time. And this one has a 4.3 IRR over this short time horizon. No new commitments this quarter, but again, I mentioned there was some good capital deployed in the space. If you look at the cash flows in total, $20 million was called within venture capital, and that's sort of the largest quarter in recent history, as you can see from this chart here. From a performance perspective, page 23 again shows the individual partnerships. Many of these are very new. Several are listed as not meaningful, and the ones that do have performance again are really early in their cycle. So some good promising performance early on so far, but in total the IRR is 4.3% for this program. And then from a vintage year and geographic focus, again, this is new, but there's a split out of different vintage years on this page. And the program continues to get vintage-year exposure as time goes on. And from a geographic focus, this is primarily North America with about 30% global. Those are all my prepared remarks on our report. The next handful of pages, we included some market commentary. We'd be happy to take questions on anything in this report or anything on that commentary, so I'll go ahead and pause.
Can I go ahead with the question?
Yes, go ahead.
So I'll ask the same question that I asked Newberger. So when there are secondary sales, for example, many of the college endowments have talked about it. Is it standard practice among our peer group that we don't need to reprice our own, holdings if it's the same fund that was sold at a lower price?
That's correct. So all of these funds have valuation policies for how they value their underlying assets, and that's not affected by whether or not someone sells a fund interest in the secondary market. I think also, we was chatting with a client last week who has done some secondary sales and receives a weekly update on pricing, and they were actually seeing that stronger funds were actually selling above their value that they were priced at, so similar to Casey's comments. So far, we've seen more secondary sales as sort of repositionings to clean up portfolios and maybe preserve some liquidity in the case of endowments with the current environment. But we haven't seen that affecting your fund values.
Thank you.
Any other questions before we move to the total pension?
Go ahead.
All right, thank you. So I'll start on the economic update on page 5 of our full pension report, just to sort of review the market environment through March 31st and talk about what's happened since then, which, of course, the markets have not been exciting at all in the month of April or since. We have, some volatility. I think what we're all hearing in the news, though, would not cause us to think that your fiscal year-to-date returns are above their actuarial targets. So despite all of the volatility and all the headlines, the markets are actually returning some decent numbers. So you can see here on the left side of page 5, the commodity index was the strongest one during the first quarter. Commodities were one of the worst performers in the quarter to date since the end of the first quarter, down 3%. MSCI EFA, which is developed non-U.S. markets, you can see we're up 6.9% in the first quarter. Since the end of the first quarter, they're up another 10.5%. So really strong returns for non-U.S. markets. Taking a look at TIPS were up. Treasury inflation-protected securities in the first quarter, they've since given back about 0.5%. Emerging markets are another really strong point recently. You can see a 2.9% return for the first quarter. Emerging markets are up another 7.1% since the end of March. A lot of that has been on strength for Chinese equities. The Bloomberg aggregate or investment grade bonds up 2.8% in the first quarter and about flat since then, whereas you have high yield exposure that has come up another 2% since the end of the first quarter. Overall, the MSCI All Country World Index or ACWI that you can see was down 1.3% in the first quarter, is up 7.9% since March 31st. And you can see here, U.S. equities were negative in the first quarter. They have since been more positive since the end of the first quarter. So despite all of the volatility in the headlines, we actually have some relatively strong market returns recently. Moving into your fund specifically, in the interest of time, as you know, there is more market commentary and also your watch list, and any manager that has a return behind their benchmark for 3 or 5 years is on the watch list, even if their longer term performance or peer relative performance might be positive. So we will skip to the overall asset allocation on page 30. You can see the total market value at $5.3 billion as of the end of March. During the first quarter, there was $115 million in outflows from the pension. There was also $83 million in investment gains for the first 3 months of 2025. You can see that the current allocations are quite close to their policy targets. On the next slide, we get into performance, and you can see that the total fund had a positive 0.6% return during the first quarter of 2025, and that was double the return of the policy benchmark and the peer median. So right around the top third of peer funds. Fiscal year to date as of the end of March, up 3.8%, bringing the 1 year to 5.7, 3 years at 4.3, and a 5-year return here of an even 10%, which doesn't happen very often, but that's above median and also above the policy benchmark for the 5-year period on an annualized basis. If you look at the sources of return recently, you can see that public equity in particular outperformed benchmarks, all areas except for emerging markets equity within the public equity space outperformed benchmarks for the first quarter and the fiscal year to date. So that includes global equity, U.S. equity, and international equity. And we have returns in here for every manager in your program. As expected, some are outperforming for the quarter and some are underperforming, but led to that return for the quarter that was double that of the policy benchmark as a whole. We're happy to take questions about individual managers, but I would just maybe draw your attention to sort of the risk environment in the fund. So if we take a look at the 5-year and 10-year risk metrics here, Colin's moving ahead. We have the 5 years here, the annualized return on the left, which is above the median for the peer group, the annualized standard deviation or volatility in the second bar chart here. So top quartile standard deviation relative to peers, so lower risk than peers, brings us to Sharpe and Sortino ratios that are measures of risk-adjusted return that are quite strong for the 5-year and have also brought the 10-year to quite strong positioning on a risk-adjusted basis relative to peers as well. So happy to take any questions on the pension fund and positioning or anything happening in the market environment.
Okay, Andrew, could I go again?
Yeah, please do.
So just some comment and also a question, I guess. I know a couple of years ago, I guess, we had increased our private market exposure. The good thing is we still, I think the target is 27.5. We're still below, so we're investing in a period when private markets have underperformed. Now, the question is, if I look at the 1, 3, and 5 years, actually, the private markets are underperforming public markets. Any thoughts, Laura, in terms of, is there a change in regime, or is it just the, asset classes go through, ups and downs, and actually maybe it's a good time to be entering more, adding to private markets?
Those are good questions. I think as a whole, I wouldn't necessarily say that private markets are underperforming public, because if we were to look at a public markets portfolio that has both equity and debt, I think, private equity, as you have diversified exposures. A 5-year average annual return of about 11% for private markets, I would say, still isn't necessarily underperforming public and has provided you with a lot of diversification. I do think where it's a good time to get into private markets is maybe less around the valuation perspective and more around what we were just talking about perhaps some funds reducing their allocations. A lot of the large endowments that have been major investors in areas like venture capital, and have monopolized some of those, high conviction, hard to get into funds, are making lower commitments than they have in the past, or maybe skipping certain fund vintages. And so I do think there's an opportunity for funds that are getting into certain areas for the first time or trying to build those programs to take advantage of that space in oversubscribed funds historically.
Okay, thank you.
Of course.
If there's no other questions, go ahead and go to
Thank you. To wrap up on the healthcare trust, as we discuss every quarter, your healthcare trust is a bit higher volatility, higher risk, sort of intentionally, given your actuarial target return than many other healthcare trusts. Over the long term, that has served it quite well. If you take a look at asset allocation, you can see that the total value of the healthcare trust as of the end of March was just under $370 million, and current allocations were quite close to policy. If we look at the next slide and take a look at performance, you can see a strong return of 1.3% for the first quarter of 2025, outperforming the policy benchmark and also the peer group. And that really, that outperformance relative to the policy benchmark flows through for the past 5 years. And you can see that the 5-year return in particular is at 9% relative to the peer group median at 5.1. So, the higher risk positioning of this fund over what, some might describe as a full market cycle of 5 years or so has been positive relative to the peer group, ranking in the 12th percentile or top 12% of the peer group. As you know, this fund invests in a subset of the managers, mostly in the pension fund, and doesn't have private markets, and also uses a lot of index exposure. So I won't go too far into the individual managers, but in terms of risk positioning, you also have strong risk-adjusted returns in this fund over the last 5 and 10 years.
Any questions? Go ahead, David.
Yeah, I was just looking at the performance here on the slide. Looking at the 1-year, 3-year performance versus policy benchmark, I see that in this situation, the healthcare trust is outperforming. In contrast, the pension plan portfolio is underperforming. Just, quick high level, what's the cause of that? Is it because the privates, there's no private in healthcare trust, that's why we're outperforming the policy benchmark, whereas the other one, we're underperforming? This is for 1 to 3 years.
So I think, the only, for the fiscal and the 1 year is,
Yeah.
so for the longer time periods, the pension trust is outperforming its policy benchmark, similar to the healthcare trust.
Yeah.
So, there are just so many different exposures between these two funds. Private markets is one area. Another one is just having active manager exposure in the pension trust. So as an example, last year, the pension trust emerging markets active managers were outperforming by quite a bit because they underweight China, overweight India. That was a very positive thing. That was not a positive thing in the first quarter of 2025. So you have those active manager exposures in the pension trust that are going to cause it to outperform and underperform in different ways in different market environments relative to the healthcare trust, where you're just getting a lot of beta exposure.
Okay, thank you.
If there's no other questions, thank you, Laura, Colin, for coming out and giving the presentation.
Thank you very much.
Thank you.
So there is no old business, so we'll go to new business. Oral update from CEO John Flynn.
Good morning, trustees. If you'll allow me a quick personal note, 26 years ago today, I married my high school sweetheart. And in the past 12 months, she's supported me in taking this position and shouldered most of the burden in preparing for our final stage of the move to become San Joseans. But the reality is she's been supporting me for a lot longer than the past 12 months. So I just want to send a personal note out to her to say thank you for the support, and I look forward to the next stage of our life together here in San Jose. So, but back to business. ORS staff schedules have been adjusted to come in alignment with the updated CMO guidance of a minimum of 32 hours a week in office. I want to thank the staff for their partnership as we work through everyone's schedule and coming to deliver the start of that this week. We have 2 upcoming vacancies, both in our benefits group. You may remember last month I reported that we were fully staffed. But we now have 1 benefit analyst position that will become vacant on Friday, June 13th. And we have a staff specialist in our health group. This position will become vacant due to retirement in July. Also, with the hopeful approval of the City Council budget on Tuesday, ORS will start the process of recruiting for the position of a program manager that will become available on July 1st. ORS will commence recruiting activities as soon as possible, which of course also includes seeking exception from the city's hiring freeze in order to start these recruitments. Procurement contract update. So we have a number of contracts in process. So I'm just going to run through them very quickly. Sussman and Johnson, we're waiting for an insurance certificate, but the contract is ready. We believe the contract is ready to be signed. Hanson Bridget is in second round of review. Ice Miller, first draft was sent to them about 2 weeks ago, and we're still waiting feedback. So we're pressing on that a little bit. I think I just saw some meeting requests come out later this week, so that's good. Reed Smith, first draft went to Reed Smith yesterday. Chiron, the first draft contract went to Chiron also about 2 weeks ago, and we're pushing to follow up with them. Milliman, I don't believe we've sent the first draft of that contract out yet, but being that Milliman is our actuary auditor and we're not due to audit them for a little while, we've put that at the back burner of all the contracts we have going on. With our governance consultant, Aon, second draft went to Aon early last week, and we're waiting for feedback on that. And then we have 2 communication contracts that we're working on. One was signed yesterday, and the other one we're working through. It's an amendment, so we're just working through the process administratively to bring all of the insurance requirements in alignment with the current city recommendations. A couple of these are, we have June 30th dates, and so we're really pushing hard to try to get them implemented. But we are running up against the end of the fiscal year, and so I am starting to get a little bit nervous. But staff is pushing to follow up, and once we get feedback, we will make that top priority so that we can turn those around, so that we don't have any gaps in services. I will note I also met with Gallagher, our compensation consultant, yesterday. We're going to talk about that a little bit later in the agenda, so I'll hold off on giving an update on that. We're working with the building on our new space. The building is driving very hard to deliver our extended office space for July 1st. We're pushing hard through the city's procurement process to order the needed furniture and schedule installation. It'll be a race to the finish to see which one finishes last. All of this work also includes all the needed IT wiring that will make the new space functional. Reminder, we hold quarterly retirement workshops. These are Zooms that members can register for on our website. Workshops are for Tier 1 and Tier 2 members who are within 1 to 2 years of retirement. Workshop is approximately 2 hours. We've been getting some good attendance at these. The next police and fire is scheduled for August 28th in the morning from 8:30 to 10:30. It's a good way to get your questions answered as you're approaching retirement. ORS's Barbara Heyman and Jay Kwan were invited to speak at SJREA's meeting on June 12th in the Leiningers Center. This is the civilian retirement organization, and we go and speak at some of their meetings throughout the year, including open enrollment, which will be coming up in October. ORS Summer Picnic is planned for Friday, June 27th. It will be held at Kelly Park. And then lastly, June 19th and July 4th, we will be observing Juneteenth and Independence Day respectively, and the ORS offices will be closed. With that, I'll take any questions.
Doesn't look like there's any questions. Thank you. I'll go ahead and move to 4B, oral update from our City Council member, Casey. Welcome. Good morning.
Thank you. Pleasure being here. Brief update. This next Tuesday, we'll be voting as a council on the mayor's June budget message, so tune in to see the results.
Thank you. 4C, we are going to defer. This was the discussion on the boards to move this board meeting to ORS office. We're deferring this mainly because there's so few of us here today. This decision is going to affect a lot of people. We did seem like our last discussion in May, there was good support, but we never got to vote on it. But since we're missing a third of the trustees here, we are just going to defer this till next month, which means that the August meeting will be held here at City Hall. That brings us to retirements. Glenn R. Albin, Police Lieutenant, Police Department, effective January 28, 2025, with 85 years of service with reciprocity. Jeffrey R. Bannister, police officer, police department, effective June 21st, 2025, with 28.3 years of service. George Constantine, police sergeant, police department, effective July 6, 2025, with 25.94 years of service. Angel L. Dizon, Jr., fire engineer, fire department, effective July 20th, 2025, with 25.14 years of service. Rocco T. Francisco, fire engineer, fire department, effective August 3rd, 2025, with 24.58 years of service. Paul A. Gonzalez, fire engineer, fire department, effective August 2nd, 2025, with 28.07 years of service. Walter Guerrero, fire captain, fire department, effective July 3rd, 2025, with 25.44 years of service. Santos A. Jimenez, firefighter, fire department, effective May 8th, 2025, with 23.24 years of service. Sorry if I pronounced John's last name wrong. John Matsaritas, thank you. Police officer, fire police department, effective June 21st, 2025, with 29.26 years of service. Keith L. Niemer, police sergeant, police department, effective July 4th, 2025, 25.07 years of service. Ramiro Perez, police officer, police department, effective July 5th, 2025, with 6.92 years of service. Michael T. Stahl, police lieutenant, police department, effective June 7th, 2025, with 26.63 years of service. Ray R. Trevino, Jr., fire captain, fire department, effective May 24th, 2025, with 22.62 years of service. Rocco C. Zanato, police officer, police department, effective August 2nd, 2025, with 25.15 years of service. I'm going to just name the deferred vested, but we'll take separate votes on these. But Jeremy Bowers, police lieutenant, police department, effective July 18th, 2025, with 28.63 years of service with reciprocity. And Eric S. Michelle, police officer, police department, effective June 30th, 2025, with 26.73 years of service with reciprocity. So can we get a motion? This will be the motion for service retirements by Santos, second by Woosley. We'll go ahead and take a roll call vote. Kwan?
Aye.
Flicker?
Aye.
Gardenier? Aye. Santos?
Yes.
Woosley?
Yes.
And Eshwar?
Aye.
All right. And can I get a motion for the deferred vested?
So moved.
Motion by Santos,
Second.
second by Woosley. Go roll call vote. Kwan?
Aye.
Flicker?
Aye.
Gardeniers? Aye. Santos?
Yes.
Woosley?
Yes.
And Eshwar?
Aye.
Aye. All right, those motions carry. At this time, love to take any comments, from our trustees.
Well, of course, we wish them all the best of health, and there's a lot of years of experience, and especially some of the police officers with 29. That's very commendable.
Yeah, I'm looking at this list, and I've worked with all these people, and it's kind of awkward to start seeing my peers retiring.
Very soon.
Live long and prosper.
Yeah, and I want to just echo what everybody else says. There's a lot of names I've worked years with, and it's going to be sad to see them go. But I appreciate the service that they provide the city, and I hope they have a long and happy retirement. So we'll go ahead and move to death and survivorship notifications. Notification of the death of Ronald Catado, fire captain, retired August 2nd, 1989, died May 2nd, 2025. No survivorship benefits. Notifications of the death of Richard Frechette, police sergeant, retired August 25th, 1990, died April 9th, 2025. Survivorship benefits to Sylvia Frechette, spouse. Notification of the death of Dennis J. Luca, Police Lieutenant, retired February 16th, 2022, died April 30th, 2025. No survivorship benefits. At this moment, we'll take a silence. One moment. Thank you. Any comments?
Yes, I worked with Captain Cataldo, and he was in the Giants minor league in his early life, and he was one hell of a good officer, and also had the privilege of working with Lieutenant Luca, who became an attorney, and he was real good for the Alviso community way back when, so wish for them the best. Unfortunately, left too soon.
Yeah, happy to see some long retirements here, but our thoughts go out to the families of those firefighters and police officers.
Thank you both, and condolences to the family. All right, we're going to go to the next section of our agenda, committee report outs. Start with investment committees. Menon, do you have any comments? Oral updates?
Investment committee, we haven't had a meeting since our last board meeting, so the next meeting is in August, so nothing to report.
All right, thank you. Audit and Risk Committee, I believe John's going to give the oral update on this.
Yes, Chair Lee asked me to give the oral update. We had a number of agenda items at the last audit committee meeting. It was a joint meeting with Federated. We had a discussion and action on the annual audit plan from MGO for our financial services. We discussed the current status of the outstanding city auditor recommendations. We reviewed the scope of services for the RFP for outsourcing our internal auditor, and then discussed the procurement setup, and you'll see some action items later today that get impacted by that. But and then lastly, we presented an update on our internal audit findings. There's also an action item, I think it's 7.2C. Chair Lee requested that I request that this board defer it so that he and Sunita could also be here to facilitate part of that discussion. We're in a little bit of an odd place, being that we don't have an internal auditor, but yet we have work that had been done and is being done on the audit findings, and we just wanted to recognize that work in our outstanding reporting process. With that, I'll take any questions. We will go through it some in more detail for the action items today.
Any questions? If not, we're going to go ahead and receive and file the February 2025 meeting minutes, which brings us to to C, which is discussion and action to accept 25 internal audit, which John mentioned that we are going to defer.
Right. Do we have to take a vote to defer? No.
So we'll defer that till next month when we have Trustee Lee and Sunita both present. Which brings us to D, discussion and action on establishing a joint ODHAC committee. John, were you going to?
Yes, I'll present this. So there is one memo for D and E. We will need to take separate votes. Based on our discussion with the joint audit committee, the recommendation was to establish a joint audit ad hoc committee of 2 board members, a primary and a alternate, from each board to help facilitate, be involved with the procurement process of our internal auditing service provider. It's important that the service provider that we hire understand that they report functionally to the audit committee and administratively to me and the executive team. And so in order to move through the process efficiently, The proposal is that the Joint Ad Hoc Committee will be involved in the early stages of procurement, including scoring the initial proposals. They would, based on the scores of the proposals, the finalists will be brought back to the full joint audit committees so that the joint audit committees can make recommendations to the boards on the hiring of the internal audit service provider. So the two actions in front of you today is the establishment of the joint audit ad hoc committee, and then to authorize it to work with me to set the appropriate procurement timeline and process as deemed necessary in order to do a thorough but efficient procurement process. This was not, the procurement of auditing services was not contemplated under the procurement policy of the boards, because at the time, this will be the first time that we're procuring this service, which is why we brought it as a discussion and action item to the audit committees, but now we're bringing it to the board to establish the ad hoc committees.
So does it make sense that this ad hoc committee said it needs to be, two people, one as a backup, that they should be sitting on the audit committee? It would be helpful.
Yes, I not just because the trustee isn't here today, but I believe that the audit committee recommends Trustee Ganapati to be the primary representative, and I think Trustee Woosley as the alternate?
That was correct.
Correct.
Yeah.
And so, yes, we do agree that it makes sense that it's somebody who's going to feed into the audit committee, which would be most appropriate. And we say two just because what we learned from the ad hoc committees of the previous procurements, sometimes people aren't available, so having an alternate helps with the efficiency. And the committee would be established until the vendor executes all contracts.
Yeah. So I'll make a recommendation that we create this ad hoc committee with Trustee Ganapati as the primary and Trustee Woosley as backup.
Is that a motion?
I'll make that's my motion.
I'll be a second.
Second by Santos. Any discussion? No? All right, we'll go ahead and do roll vote. David?
Emphatic yes.
Gretchen?
Aye.
Gardner's aye. Santos?
Yes.
And Woosley?
Yes.
Trustee Menon?
Aye.
All right, that passes. And the next motion that we will need is to give delegation authority to the joint ad hoc committee.
So moved.
Motion by Santos,
Second.
second by Woosley. Any further discussion, comments? Not, roll call vote. David?
Aye.
Gretchen?
Aye.
Gardner's aye. Santos?
Yes.
And Woosley?
Yes.
Trustee Menon?
Aye.
Aye. Okay, that motion passes. All right, Governance Committee, oral update. Trustee Santos?
Everything is wonderful. The CEO is going to get us a meeting.
So we were originally scheduled to have a June meeting. Again, one of the contracts we're working on is with our governance consultant. I believe the meeting would have been today, and so we knew we weren't going to make that. So we're looking at time in August. Hopefully that'll give us enough time to complete the execution of the contract, onboard the consultant, and then start sprinting towards some of the timely activities that we will need to get them engaged in, including executive evaluations, this board's evaluation, and planning for our retreat and strategic planning. So we got a lot of work on their plate that we'll be working with the governance committee on, but we requested to move to August.
All right, thank you. 7-4, Disability Committee.
Yeah, we got the minutes in the dashboard, and we'll have them here, what is it, this Monday at 10 o'clock. I think we have 2 applicants, and staff, everyone's doing a great job.
All right, great. And we'll go ahead and receive and file the minutes for the March 10th, 2025 meeting. 7.5, JPC, Trustee Menon.
Yeah, since the chair is not here, as a vice chair, I'll say the chair. It says chair of the JPC, who's part of the federated, but So nothing to report. Our last meeting was April 2nd, so nothing to report.
Okay. 7.5B, discussion action request, the creation of a new employment classification for Deputy Director of Retirement. John?
Yes, if you'll allow me to comment. So we actually discussed this at a previous board meeting, but because of the timing of the, it was discussed as part of the oral update, not as an action needed to be taken by the board. And so I apologize because we didn't bring it to the board last month, but we are bringing both of these to the board this month based on the discussion that we had 2 meetings ago. So 7.5B, as you might remember, we're looking to establish a deputy director position specific to retirement for the deputy chief investment officer. So we originally had made as part of our budget request, we requested a add delete of a senior investment officer to a deputy chief investment officer, or a deputy director, which we were going to call internally deputy chief investment officer. The city advised us that the deputy director position is a citywide position, and being that this is going to be part of the investment staff, they recommended that we go through a classification creation process where we create a retirement-specific deputy director classification, such that this board, our boards, could make recommendation to the city for compensation along with the other investment professionals. So what you see in the attachment that's included, you can see as an example, there is an investment officer, which is a city title, a general city title, and then there's a retirement investment officer title. So they're different classifications, different salary ranges, and when we make recommendation to city council, we're making recommendation to city council for the retirement specific classifications. So this is just authorizing me to work with cities, HR, OER, to go through a classification creation process. They will work with me to do that. I will work with them to do that, really, and then they will put that recommendation in front of city council for approval.
Any questions?
Yeah, just a quick question, just because maybe I don't have all the background here.
Sure.
Was this something initiated by the joint JPC?
Yes, this came as a recommendation out of the April 2nd JPC.
Okay.
The April 2nd meeting happened a few days before the April P&F meeting. So we actually discussed it at the April board meeting, but not as an action. It was part of the oral update. And so that's why it's coming up, what I would argue is a meeting late.
I'll go ahead and make a motion to let John start working with OER and HR to start creating this classification.
So moved. 1 second.
Motion by Gardenier, second by Santos. Any other further comments, questions? If not, we'll do a roll call vote. David Kwan?
Aye.
Gretchen?
Aye.
Gardner's aye. Santos?
Yes.
Woosley?
Yes.
And Trustee Menon?
Aye.
All right. That brings us to 7.5C, discussion and actions to commence an updated compensation study for all current and proposed retirement investment staff classification exclusive of the CIO.
So using the same reference of the city listed classifications, the JPC, my understanding historically is that there was a study done approximately 2 years ago to compare our investment staff across comparator pension funds in the nearest geographic location that would make us comparable. That then formulated a request to city council for changes to the compensation ranges for our investment classifications. Those were denied by the city at the time. So the JPC is requesting, making recommendation that we initiate a new compensation study, this time focusing just on the investment staff, not, because at the time, I believe the previous compensation study also included the CEO and the CIO. So we're narrowing it down a little bit, but we want to make sure that we're at least competitive among our pension fund peers for the investment staff that we currently have in-house.
Any questions, comments?
And who would you propose to do this study? You have somebody identified?
So I'm in discussions with the firm that was used previously. The firm previously was recognized as COF, but has changed names to Gallagher. We're currently working with Gallagher to define a proposal to do the work. But I think maybe even more important, trying to establish what the methodology will be up front. And then I plan to reach out to administration here at the city, because it seemed that there was some friction at the time that some of the methodology that was presented to City Council wasn't in alignment with city standard practice. And so what I'd love to do is get pre-approval is maybe too strong, but pre-agreement and take some of that noise off the table so we can focus on the data and let the results stand for itself.
Yeah, sounds like a good idea.
And Gallagher, formerly COF, the city's familiar with them. They've used them in the past with other, vendors before. So it's a reputable company. I'll entertain a motion for.
So moved.
Motion by Santos. We got a second by Woosley. Any further discussion, comments? No. Roll call. David Kwan.
Yes.
Gretchen.
Aye.
Gardner. Yes. Santos.
Yes.
Woosley.
Yes.
And Trustee Menon.
Aye.
All right, that passes. All right, 7.6 legal service ad hoc report out. Votto and Ganapati are both on that committee, and they are not here.
If you'll allow, we haven't met as a committee. The committee is established until we sign contracts. What I would say is the boards have authorized me to negotiate contract with all of the legal providers that have been selected as part of the competitive procurement process. So as soon as we sign our last contract, that committee will dissolve officially. But unless we run into complications through the contracting process, I don't expect that we will meet again.
Okay, thank you. 7.7 actuarial service ad hoc. David?
Same thing.
Okay. 7.8 investment governance ad hoc. Trustee Menon or David? Any comments?
You want me to go first, David?
Yeah, sure. Go ahead.
Yeah, so first of all, I'd like to thank our consultants, Eileen and Laura. They've been tremendously helpful. We've had a number of conversations. Also want to thank the CIO, who's not here, Prabhu. I think he's discussed this with both David and me. The process is moving along. David and I, I think are in agreement on how to move forward, but David, you take it away.
Okay. I agree with everything Ashwar has stated. I think that we're both in agreement on most of the issues. I think we're just fine-tuning the verbiage. So I expect that that we'll be reviewing it, the IPS, in August and discussing it out, obviously.
Okay.
Nothing else.
Any questions? All right, thank you. Proposed agendas for our August meeting. If there is none, just last parting comments. Just remind July there is no meetings, so we'll be back here at City Hall in August. This meeting is adjourned. Thank you.
Good job.